Very good morning, friends. So I hope you're doing well and your preparation is also going on a good track. So we were revising the concept of consolidation standards and a lot of trail in the standards. Our focus right now is on the business combination standard, that is India's 103. So last time we have done questions pertaining to two areas. One is on the acquisition accounting, and we did one question on the reverse acquisition accounting as well. Typically, in terms of reverse acquisition, we did a question where there was no new entity created. Now, if you look at the concept of reverse acquisition, there are technically, you can say, two kinds of question. One is where a new entity is not created, and one is where a new entity is created. Now, you would recall that when we were looking at the step where we were finding out the accounting acquirer, we identified that there are two cases when a reverse acquisition can happen. If a no new entity is created, you need to get the percentage post business combination to identify is the control still there or the control is lost. That's the kind of question which we saw in the last class. Then there is another question, case where we can say a new entity is created and the consideration is primarily in shares. And we said, that would undoubtedly be a case of reverse acquisition. So what I'm going to do right now, I'm going to do the second category of question where a new entity is created. The consideration is primarily in terms of shares, and definitely it becomes a case of reverse acquisition. Thereafter, we'll do a question on the concept of a common control, because there are three accountings in terms of 103. One is acquisition accounting, one is reverse acquisition, and one is a case of common control. Then we'll push on to the next standard, that would be 110. But I think first we need to cover these two aspects in 103. So I'm going to first of all take you to a question which is pertaining to reverse acquisition. So this question, I guess we've already done. So I just remove this particular case. So let's have a look at question number 9. Let me just, I think, crop this a bit. Question number 9. I hope that is visible enough to see. I hope the visibility is fine.
Yes, sir.
Okay, perfect. Okay, so I think I'll read on the facts given in question 9. It says AX and BX amalgamated on and from 1st January X2. And very clearly it says a new company ABX is created with the shares of 10 each formed to take over the business of the existing company. So I think one of the parameters is getting satisfied that a new company is being created. Now, if the consideration is primarily in shares, undoubtedly it's a reverse acquisition. And then we are given the balance sheet and the notes to accounts. ABC is going to issue requisite number of shares to discharge the claims of the equity shareholders of the transferred company. Also, the new debentures are issued in exchange of the old series of both the company. We need to calculate the purchase consideration and the discharge and also make the draft balance sheet of the new company, that is ABX. So I think we can very clearly see the inputs that a new company is created. The consideration is primarily in shares. Undoubtedly, we know it's a reverse acquisition, but we'll still go with our 6 steps in terms of reverse acquisition. So let's begin the journey. So we will first of all start with the 6-step model in this case. So the answer to question 9. So the first thing we're going to do, as usual, get the date of acquisition, step number 1. So as far as the date of acquisition is concerned, very clearly given in the question. So we give the date of acquisition is 1st January X2. So the date of acquisition is 1st January X2. Then we get on to the step number 2, that is identifying accounting acquirer. So I think for this purpose, we need to organize the percentages. So first, I think we'll see what is the total number of shares given to the two companies, that is the two existing company AX and BX, and then we'll proceed further. So let's consider the company AX as well as BX. Let's see what is the status of the number of shares. Now, in this particular case, we are given the inputs. So I think there is something which has got missed in this question, I guess. Yes. There is another inputs which I didn't read. This is the further inputs. So there is more data which is given out here. So we are assuming that both companies are under a common control. But right now my focus is not the common control. My focus is the point number B. Assume BX is a larger entity and the management will take the control of the entity. So it's very clearly given that BX is going to be the accounting acquirer, but we're still going to identify that. And then the fair value of the net assets of both the company, AX and BX, is also defined. Okay. Now, the most important information which I need right now is the fair value of the business. Because based on the fair value of the business, we'll decide how many shares are to be given to the shareholders of AX and BX. So fair value is 11 and 12. So we pick up the fair value of the business. So fair value of the business is supposed to be 11,000. And fair value of the business is supposed to be 14,000. Now, since a new company is created, undoubtedly we can say the shares will be issued at a par value, and let's assume the par value to be 10. So we'll divide this by the face value. The shares will be issued at the face value of 10. So we will be able to get the number of shares that will be issued to the shareholders. That's 1100 and that's 1400. So the total number of shares which are issued is going to be 2500. And I think let me also connect a small little dot further out here. So we are given out here that it says ABX will issue requisite number of shares to discharge the claims of the equity shareholder. So requisite number of shares would mean based on the fair value of the shares, you will issue 1400 and 1100 shares to the shareholder. Okay. So I think now what I need to do in this case, calculate the percentage stake. So let's see in terms of AX and BX, what is the percentage stake they will have. Shareholders of AX will get 1100 shares out of 2500 and BX will get 1400 shares out of 2500. So let's see what is the percentage the shareholders will get in this combined entity.
44% and 56%.
That's wonderful. 44% and 56%. So that is the percentage stake. So can we say, looking at this percentage now, BX is the major stakeholder of ABX, so he gets a control. So in this case, we can say he gets control. So one of the existing companies, that is BX, gets a control. So undoubtedly, you can tell the examiner that this is a reverse acquisition. And we can then identify that the accounting acquirer is BX. So the accounting acquirer in this case is the company BX. I think just a little safe question again to put across. Is there a necessity of calculating this percentage, since the question has already given me that BX is the larger entity getting a control? Is this important to get?
Yes, sir.
Yes, that's right. And for the reason that when you go to calculate a purchase consideration, we definitely need this percentage to calculate the PC. So even if the question tells you very clearly that who is the accounting acquirer, we still need to go through this process. Okay, so that's step number 2. Now let's go to the step number 3. So in terms of the step number 3, we need to get the list of net assets. We're not given any tax rate. So step number 3A in terms of deferred tax is not applicable. So I'm just directly going to the list of net assets. Now, when you go to get the list of net assets, whose net assets will you organize? AX, BX, whose list of net assets will be organized?
AX.
That's right, because AX is the accounting equity. So we need to get the list of net assets for the accounting equity in this case. So let's go back and see the data. So I guess we are given the assets of AX, but there are some fair values which are already given. So we just pick up the fair value of PPE as well as inventory. So 9,500 and 1,300. So we can take the data. PPE is 9,500. Inventory is 1,300. Then rest we can pick it up from the balance sheet itself. I'll just quickly go back to the balance sheet. So PPE is done. Then we've got investments. I have the question in front of me, so I'm just going to pick up the data. So all the balance sheet items will be seen. So let me just, I can take the data from the balance sheet. So on the balance sheet, we've got investments 1050. So investments is 1050. Then next we are given inventory is done. Trade receivables is 1,800. Then next we are given cash and cash equivalents is 450. And I think that's it on the asset side. Liabilities, we've got debentures, that is 3,000. So debentures is 3,000. We're going to give them the same amount of debentures. And then there is trades payable, that is 1,000. I think that's it. Nothing else is given. So we can comfortably get the net assets of this company. I guess it comes to 10,100 is the net assets of accounting equity. Right, so I think this is done. The step number 3 stands done. Now becomes the crucial step number 4, where you need to calculate the purchase consideration. So let's see step number 4. So step number 4, we need to calculate the purchase consideration. Now, this is a crucial step. So we've already seen that in terms of reverse acquisition, you're going to show two things to the examiner. So as I said, you can show the second alternative as well. That's what we were discussing in the previous class, but I think it's more appropriate to show two things. We don't need to calculate what is given by ABX to the company. We need to consider that if BX would have paid, how much he would have paid in order to maintain the percentage of 56%. And then we also decided PC is not what you are supposed to pay. PC is the fair value of what you acquire. So I think let's get some insights from your side. So I'll take this PC divided in two parts. First, let's consider what BX would have issued. What BX would have issued to maintain 56%. So we need to calculate what BX would have issued to maintain 56%. So now what we need to do, calculate the number of shares which BX would have given to the shareholders of AX to maintain this percentage. So for this, we need to go back to the balance sheet. And let's see the balance sheet of BX. So can you see BX has got equity share capital, that is 700. So let's come back on the calculations. So we can say BX has got a total of 700 shares. And we assume that if we would have issued, let's say, X number of shares in such a way that the percentage would have been 56%. So we would say that he's got 700 shares in the company. If he would have issued X number of shares to BX, the percentage maintained would have been 56. So let's see what is the value of X.
550.
Wonderful, very fast indeed. Okay, so that comes to 550 shares. So we can calculate the purchase consideration, and that is 550. Can I say we need what? The fair value of the share? And do we have the fair value of the shares? Directly no. So tell me, how are you going to get the fair value? How will we derive the fair value of the shares for AX as well as BX? Okay, I think I'll tell you that. So can I say we have the fair value of the business? We can divide the fair value of the business by number of shares to get the fair value per share. So we know the fair value of the business. This can be prepared as a separate working note. When you're presenting things in the exam, so this calculation, what I'm presenting, can be shown as a separate computation as a working note. So I think the fair value of the business, if I rightly remember, was 14,000 and 11,000. We divide this by the number of shares. I guess the number of shares in this case was 600 and this
Sir,
was 700.
AX is 11. AX is 11,000.
Okay, it's the other way around. Okay, number of shares I think is fine. So this is 11 and this is 14. So we can get the fair value per share. So this is going to be 20 and 11,000 by 600. This is, I think, 18.33. Okay, so this organizes the fair value of the share. So we can just multiply this with what? So multiply this with 18.33 or multiply by 20. This is the shares of BX. So multiply by 20, that comes to 11,000. And by the way, this is coming equal to the fair value of the business of EX. Is this by chance or is this got to be?
Got to be, sir.
Absolutely correct, because in this case, at the end of the day, the purchase consideration paid is equal to the fair value of the business. So we're just getting the bifurcation of that 11,000, that how many shares issued at what price, the consideration remains 11. Now, the other calculation which we need to show to the examiner is that we need to calculate the fair value of what is acquired. We need to calculate the fair value of what is acquired, because we'll tell the examiner that this is more reliable in nature. Instead of calculating the fair value of what is given, we need to calculate the fair value of what is acquired. So can I say, in terms of fair value, what is acquired? Can you tell me what did you acquire? BX, by giving the shares to AX, gets what in return? I guess all the technical questions I need to answer. So can I say he gets a control over 600 shares of AX and the share price of AX is 18.33. This also comes to 11,000, because once BX pays a consideration to the shareholders of AX, he's going to get the control over the shares of AX. So 600 is the shares over which he gets a control, fair value of what is acquired. Okay, so I think in any case, the purchase consideration which we have calculated, this 11 as well as this 11, of course, is same. And as I said, invariably, this is going to be same. Though you can do this particular calculations directly, but as I said, it's more appropriate. You show the examiner the fair value of what is given and the fair value of what is acquired, and then make a conclusion that what is more reliable is the right hand side. Okay, so this is step number 4. Now let's go to the step number 5. So step number 5, we need to calculate the amount of NCI, and there is no NCI given. So there is no NCI which is given. Then we need to consider the step number 6, And step number 6 is in terms of calculating goodwill or the bargain purchase gain. So this is a simple mathematical exercise. We take the purchase consideration to which we add the NCI, and then we compare this with the net assets, and we'll get the goodwill or the capital reserve as the case may be. So purchase consideration is 11,000. There is no NCI. And what was the net assets?
10,100.
Yes, that's 10,100. So we get a difference 900 that is supposed to be goodwill. Okay, so I think that's it. We don't do the 7th step in terms of reverse acquisition. Then you need to make a consolidated balance sheet. You want me to make the consolidated balance sheet, or do I skip that? As you're comfortable. You want me to make the balance sheet, or do I skip the balance sheet?
We can prepare.
Will you make it? You want me to make it?
Yes, sir.
Okay, then I think let's make the consolidated balance sheet as well. So on the consolidated balance sheet, we'll start with the asset side. Now, the focus points which I gave you earlier as well. So when you go to consider the balance sheet of ABX, this consolidated balance sheet is prepared for the new company ABX, because the legal requirement to present the balance sheet is of the company ABX. So you will consider the fair value of which company, AX or BX. BX is the accounting acquirer. So can I say AX will take the fair values and BX will take the book values. So let's begin with the asset side of the balance sheet. So I'm just going to make a little unstructured balance sheet, not taking all the headings, just taking the basic inputs. So we've got a PPE. So we take the fair value of AX and we take the book value of BX, that's 7,500. So I think that comes to 17,000 is the property, plant, equipment in this case. Okay, next I am given in the figures, I think least we forget, there is a goodwill. That's to the extent of 900. Next in the balance sheet is investments. I think investments, we are not given any fair values, so we can directly consider 1050 plus 550. That makes it 1600. And that's it on the non-current assets. Then I think we can take the current assets inventory. Inventory, we are given a fair value. That's 1300 and it is 2750. Fair value is 1300 and this is 2750. So it comes to 4050. Next, we're given the trade receivables. That's at the book value itself, 1800 plus 4000. That makes it 5800. That is the trade receivable. Then there is a cash and cash equivalents. That is again the book value 450 plus 400. And I think that's it on the asset side of the balance sheet. So let's see what is the total of the asset side. 17,900, 1600, 4050, 58,850. This is, I think, coming to 30,200 is the total asset side of the balance sheet. Okay. Now we come to the liability side of the balance sheet. So equity and liabilities. So in terms of equity and liabilities, so we have, first of all, the equity share capital. Now you need to tell me what is going to be the equity share capital in the company. So are you going to take BX as a base or AX? What are you going to do to calculate the share capital? I think this is something, which is crucial. So let's put that question to you. How much is going to be the equity share capital in the balance sheet? No inputs on that. I need that answer. It's a revisionary class, so I'm not supposed to give you all the answers. So, calculate in the meantime, let me, I think, go further on the balance sheet. Then we have on the liability side, so I'll wait for your inputs on the share capital and the other equity. So next is the debentures. Debentures, we are issuing the same face value. So that's, I guess, to the extent of 3,000 and 4,000. So that works out at 7,000. And then there is trades payable. So trades payable is again at book value. That's 1,000 and 1,500. So that works out at 2,500, and this would of course be 30,200. So tell me, what is the equity share capital? I'm still waiting for your inputs on that. What is the amount of share capital and other equity to be taken? Nobody? My God. What is going to be the equity share capital in the balance sheet of this company? So are you going to consider the share capital of BX plus the purchase consideration? Okay, I think I'll have to do the needful. Nobody's going to give me an answer on that. Oh my God. So the share capital of the company BX is appearing to the extent of 7,000. And the purchase consideration, we issued, I guess, how many shares were there? I guess that was to the extent of 550 shares. So that's going to be 550 shares, 10 is the face value. So this is going to be 5,500. So 550 shares into 10, that is the face value. This is 12,500. And I can take equity as a balancing figure and keep supporting. So this, I think, comes to what, 8,200, I guess. So then we can support this 8,200 as well. So that's, I think, 2,700 was the other equity. And then this 10 rupees becomes the premium. So 5,500 plus 2,700, that works out at 8,200. Right, so the balance sheet is done. So this is on the case of a reverse acquisition. So acquisition accounting is done, reverse acquisition is done. Now we're going to go to the focus in terms of common control. So first we make a mind map on the concept of common control and then do a question. So let me first make a small little mind map on common control. So mind map 1 for the day. So we've got mind map number 1. This is on common control transactions. This is on a common control transaction. Okay, so now the focus points in terms of common control transactions. When you are passing an entry, the first focus is this is a transaction which pertains to related party. So common controls will happen generally when there is a transaction between related parties. But that does not mean that every time there is a transaction between related parties, it would mean a common control. But if there are no related parties, common control cannot occur. Now, in this particular case, what do we need to do? So we can say in terms of the, you can say acquirer. In terms of the acquirer company, the focus in terms of the entry is you will capture the net assets. At what value? Fair value or book value? So in terms of common control, when you capture the net assets, is going to be captured at a book value. There is no concept as far as the fair value is concerned in terms of common control. In terms of common control, the accounting is quite similar to what you do in ICAI, Accounting Standard 14. There is pooling of interest method. So we consider book value, and we do not consider any asset or liability not appearing in equity's balance sheet. So we do not consider any asset or liability. So no new asset or liability will be inserted in this entry. Next, when you consider the purchase consideration, equity share capital, so this is the amount of purchase consideration. We need to consider the shares issued at a face value. You need to consider the shares issued at a face value. We do not capture the fair value. So in this case, we do not capture the fair value. That is another focus point. So taking only those net assets in the balance sheet of the equity, and that also the book value, shares issued would be at a face value. If there is any cash payment, of course, we'll take that. And now tell me, where will you take the balancing figure in this entry? Is it goodwill, capital reserve, or adjusted somewhere else? Other equity. So whatever is the balancing figure, that is going to be adjusted in terms of other equity. So another focus point is that we do not get any goodwill which arises on a common control transaction. So the accounting becomes fairly more simple. Then in terms of common control, 2, 3 focus points should be clear. When you consider the net assets, you need to take the book value. No new asset liability will be inserted. The shares are recorded issued at a face value and not a fair value, and the difference is never a goodwill, but it is adjusted in terms of other equity directly. That's it. So this is on the common control part. I think let's do a question now on this area. So I've taken this question a little earlier, I guess. Yes. So question number 6, this is on common control. I hope the question is visible, right? Okay, I hope the visibility is fine. You can see the question, right? Okay, so let me read the input. Maxi Mini has got two divisions, Maxi and Mini. The draft information for the assets and liabilities are given, and then it says it is decided to form a new company, Mini, to take over the assets and liabilities of Mini division. Just to give you a little background, though I think you would have done this question earlier in the regular sessions as well. Generally, a case of common control will involve a case of what we call a demerger. A demerger, there is an existing company, let's say with two divisions, you take out one particular divisions and create a new company. And this new company is, in this case, the company Mini Limited. So Maxi Mini will get the objective of closing that Mini divisions, and Mini Limited will have the objective of putting the entry. Now, when you create a separate company, that means in the company Maxi Mini, when you take out that Mini division and create a separate company, the shares of Mini is given to the shareholders of Maxi Mini itself. So the shareholders of Maxi Mini would also become the shareholders of Mini as well. So once they become the shareholders of both the company, you can say both the companies come under the common control of the shareholder. But in this particular case, we need either some individual shareholder who has got a control over both the companies, or maybe a group of shareholders who get a control of this company. So in any case, in terms of demerger, even if the question is silent, you can safely assume that these companies are going to be under a common control of a major shareholder or maybe a group of shareholders who have entered into a contractual arrangement. Why I'm putting these things to you? Because when you identify the concept of a common control, just to connect the dots, you need to consider number one, that first of all, the control, or you can say joint control, is with a single largest shareholder or a group of shareholder. If it is with a single shareholder, then it's not a problem. But if it is supposed to be with the group of shareholders, we need a contractual agreement between the group of shareholders that they agree to act jointly. Otherwise, it does not become a case of common control. And thirdly, you also need to prove that the control is not something which is transitory in nature. So I'm not documenting that part, but I think we've done that, that in terms of common control, it's a 3-step procedure in terms of identifying common control. At the first instance, looking at, is there a single largest shareholder, or a group of shareholders who are getting a control or joint control. If it is a single largest shareholder, you go to step 3. But if it is supposed to be a group of shareholders, then you need to go to step 2. Identify that they have a contractual arrangement with each other to act jointly. And then you go to the step 3 to see that the control is not transitory in nature. I hope the dots are connected. Okay, so coming back to the input, it says it is decided to form a new company, Mini, to take over the assets and liabilities of Mini division. Accordingly, Mini Limited is incorporated to take over at the balance sheet figures, book value, assets and liabilities of that division. Mini will allot 5 crore equity shares to the members of Maximini. So we're very clear. He tells you that the shares are given to the members of Maximini. And then it says members of Maximini are therefore to become the members of Mini as well without making any further investments. Now, what are the requirements of the question? We need journal entries in the books of Maximini and the books of Mini. Also show the balance sheet of the two companies on the morning of 1st November, showing the corresponding previous year figures. Directors of the company ask you to calculate a net asset value of the shares pre and post demerger. And then it says also comment upon the impact of the demerger on the shareholders' wealth. So we've got 3 focus points. One is we need to pass journal entries in the books of Maximini and Mini. Second, we need to make balance sheets about the company pre and post demerger. And number 3, we need to see the impact on the shareholders' wealth. Let's begin with the agenda number 1. So answer to the question number 6. So in this particular case, the first thing we're going to do is look at the entries in the 2 set of books. The focus is in terms of books of Maximini. The focus is in terms of the books of Mini. Now, as far as Mini is concerned, he is the company, which is the new company who's going to act like an acquirer. So he's going to record the assets, everything. So let's go back and pick up the data. So the focus is looking at the balance sheet of Mini. So we've got the PPE is 200. So we capture, first of all, PPE at a book value. That is 200. Then the current assets, that is going to be 300. And then there is current liabilities, that is 100. And then there is a loan funds, which is 100. So this is as far as the net assets are concerned. So all the assets and liabilities are incorporated at the book values itself. And then there is a purchase consideration. So I think I'm just going to record the purchase consideration, members of Maximini. So the consideration is going to be paid to the members of Maximini in this case. So let's see what is the purchase consideration. It says we are going to allot a total of 5 crore shares of 10 each. So 5 crore shares of 10 each, it becomes 50 crores. And where are you going to take the balancing figure in this entry? Goodwill? Or what are you going to take the difference?
Other equity.
That's right. So we'll take a balancing figure that is other equity in this entry. You can call it as a capital reserve as well. It's going to be taken in the balance sheet as a part of the other equity. But we do not get any goodwill in terms of me. Okay, now the entries in the books of Maximini is purely to close the assets and liabilities. So basically, we're putting an entry in the books of Maximini to close those assets and liabilities which are transferred. So practically, we can land up, reversing this entry. But I think what we'll do on a safe side, close the asset at a cost, close the accumulated depreciation separately. So let's do one thing, close the accumulated depreciation. That is 100. And give a credit to the PPE. That's the cost. The net effect, of course, is 200 in this case. Then we can close the current liabilities. That is 100. Close the loan account. Debit all the liabilities. and credit all the assets. That is 300. I think that's it. So all the assets and liabilities are done. Is Maximini getting any purchase consideration? No. The consideration is given not to the company but to the members of Maximini, so he cannot show anything recoverable from Mini Limited. So can I say we just need to close this entry? So where are you going to take the balancing figure? This time we're getting a balancing figure on the debit side. So where do we take this balancing figure? It's a loss arising on account of reconstruction. Other equity
Other
again.
equity.
That's right. So other equity again gets a debit. This is basically representing loss on reconstruction of the company. So gets adjusted in the other equity in this case. So I think this answers the very first requirement of the question, that is journal entries in the books of the company. Okay, now let's, I think, consider this. Okay, so I'm now going to consider the next input in this case. Let's now go to the balance sheet of the company. So now let's see what is the balance sheet status of the company. So we need the balance sheet of the company in terms of Maximini pre-post demerger and the balance sheet of the company, which is May. So let me do one thing. I think we just make a columnar balance sheet. So let's take this as particulars. Let's see the balance sheet of Maximini pre and post demerger. And this is, of course, post demerger. So we're going to make a comparative balance sheet. This is Maximini and this is Mini. This is post demerger. This is pre and this is post demerger. So we can see the comparative position very clear because he's very explicitly putting across the question. We want the inputs in terms of pre and post demerger. So first, I think we can just copy the balance sheet from the question itself. So let's pick up the balance sheet from the question directly itself. Let me just open the question in front of me. So I'm going to copy the data from the existing balance sheet. So we've got a PPE. We've got a PPE, and this is to the extent of, we've got 300, that is pre. Then there is current assets, that's to the extent of, I guess, 700. That's it on the asset side of the balance sheet, I guess. Yes, so let's take this as the total. And then we consider the equity share capital, other equity, loans, and the current liabilities. So equity share capital is appearing to the extent of 50. Other equity is 650. Loan and the current liability is 100. So I think this is the existing balance sheet with us. Now current liability is 200. So I've just copied the data as it is. So this is the existing balance sheet with me. So this is 1000 and this is 1000. Now let's, I think, incorporate the entries we have done in the books of Maximini and entries we have done in the books of Mini to get the post demerger balance sheets of the company. So I think let's first pick up the data from the Mini Limited out here. So I think he's got PPE 200. So this is 200. And he's got current assets, that's to the extent of 300. And he's got a loan of 100. And he's got a current liability 100. So let me, I think, ask you a very obvious question now. Can I take the balance out here in the books of Maximini? This is the total. This has gone to Mini. So minus, can I take a balancing figure?
Yes,
Yes,
sir.
of course. Correct. So this is going to be 500 and this is 500 and this becomes nil and this becomes 100. Now, as far as the other equity is concerned, from the 650, I think there was a 300 loss on reconstruction. That makes it 350. There was a balancing figure 250 in terms of capital reserve, which we had computed. The share capital, of course, remains the same, and he also issued a share capital of 5 crore shares of 10 each. So now we can get the total. This is 500, and this is also going to be 500. So this is done. So balance sheet of the company maximally pre-post demerger done. Second requirement of the question stands done. Let's go back now to the requirements of the question once again. So you're required to pass the journal entries in the books of Maximini and Mini Limited done. The balance sheet of the two companies done. Now it says directors want you to find out the net asset value of equity share pre and post demerger. Now, if you want the net asset value per share, can I say that would be net assets divided by number of shares? So let's see. And then the impact on the shareholders' wealth is to be defined. Now, if I want to calculate the net assets of the company, can I simply consider the sum total of equity share capital and the other equity?
Yes,
Either
sir.
you assets, that's right, assets minus liability, or you simply take the share capital other equity. Right now we are safe because we are not given the status of fair value of any of the assets. But otherwise, when you calculate the net assets, we need to consider the fair values. But in this case, being a case of effectively a merger, everything is done at a book value. So let's organize the data. So we can consider the calculations of the net asset value for the company Maximini pre and post and mini post. So this is Maximini, this is mini, this is post demerger, this is pre and this is post demerger. And now we need to organize the net assets divided by number of shares, and we get the net asset value per share. We get the net asset value per share. So as far as the net assets are concerned, the net assets can be taken from here. So this is 700, this is 400, and this is 300. And as far as number of shares is concerned, it's 10 rupee share, so 5 crore shares. So we will be able to get what is the net asset value per share. So I think this is 140, this is I guess 80, and this is 60. Okay, now a quick question, and I think I'll extend that question as well. So the quick question is, can I say earlier the shareholder of the company had one share in this company? Can I say now he's got one share in this company and he's got one share in this company? Correct? Because you gave him the same 5 crore shares. Maximini had 5 crore shares and we gave them exactly 5 crore shares. So we've allotted the shares in the ratio of 1:1. So earlier the shareholder had one share of Maximini. Now he's got one share of Maximini and one share of Mini. So 80 plus 60, the total wealth is still the same. So there is no impact. There is no impact on the shareholder's wealth. But my question now to you, if the ratio of exchange was not 1:1, would this lead to any impact on the shareholders' wealth?
No, sir.
Right. No means in the sense that the impact will not be there. That's right. Because at the end of the day, if everything is done at a book value itself, in this particular case, your exchange ratio is either 1:1 or 2:1 or 1:2. That would not make any difference. The shareholders' impact will not arise. But this is true only in terms of a demerger when it falls under the umbrella of a common control transaction. Right. So I think this takes care of the concept of a common control transaction as well. So acquisition accounting done, reverse acquisition done, common control done. Now there is one more question here which I have, but I don't know whether I should do that or not because I don't want to run short of time for the other standards. So you take a choice. There is one question which is on Index 103, which is given the study material at the test your knowledge, I think in the end. It's a brilliant question. You can have a look at the question if you want. We'll do that. So this is the question, I guess, if it is visible to you. It's a long drawn question. So if you think we should do this, we'll do this. If you think this is running in 3 pages, actually. So what do you say? You want me to do this question? Though I'm not going to do this alone. I'm going to ask you a lot of questions if you ask me to do this. So what do you want me to do this question or leave it for your web?
So we can do
Sir,
this.
We can.
do this, sir.
We can do this. We'll jointly do this. I'm not going to do this alone.
No, yes, sir. We jointly will.
We
Okay.
Sir, can you please expand it a little bit more because not
Yeah,
visible.
I'll just do that. I'll just expand it a bit. This is a wonderful question. I think it's one of the best questions which I think is there on 103. See if this is visible. Good enough to go. I'll cut that out. Is it good to go?
Yeah, but little bit better.
Okay. That might be a challenge to expand it further.
it is manageable, sir.
The manageable now we can see.
Okay. Okay. Let me crop this as well. I've intentionally increased the font size, but it's still difficult to, incorporate this at a single place. Manageable. Can you see this?
Yes, sir.
Okay. And then we come to the. So we're going to first read the question very carefully, and then we'll start solving this question. So a lot of inputs are there in this particular case. I hope it's manageable, right? You can see that, right? Manageable, I guess.
Yes, sir.
Oh, great. So now let me start reading the question with you. I'm just going to keep the question in front of me as well, because we need to read a lot of data and gather. So this is in the study material. Let's, I think, start reading the inputs given in this particular case. So I'm just going to read the inputs. As we read along the inputs, we'll keep, looking at this as well. It says H acquired equity shares. It says H acquired equity shares of S, a listed company, in 2 tranches. It says on 1st November 16, 15% shares were acquired, and then on January 17, 45% shares is acquired. I'm just not thinking aloud, as I'm reading the question, just to connect the dots. Can I say this becomes a case of a PHI, a case of a step acquisition? And in this case, it's a conversion of a passive investor to a case of control. So this means that in this particular case, we need to apply the concept of switch over Index 109 to Index 110, as well as, of course, 103. So updation of the PHI at a fair value required. Is my thought correct?
Yes, sir.
That's right. So this is a case of conversion from a passive investor. This is a case of conversion of a passive investor to a case of control. So I think we'll keep that this is a case of a PHI, or you can call it as a step acquisition. Just putting the thoughts along as we read the inputs. Okay, then it says, both the above mentioned companies have rupees as their functional currency. Consequently, H acquired a control over S on January 17. Then I'm given the balance sheets of the company where I am given the carrying value as well as the fair value. So, of course, when you're going to go to the concept of step number 3B, we'll consider the fair values. And if there is a tax rate, we're going to apply step 3A, applying the concept of deferred tax as well. Just some thoughts. Then it tells me in the additional information, it says property, plant, equipment in the balance sheet is including a leasehold vehicle with a carrying value of 1 crore and a fair value of 1.2 crores. It says at the date of inception of the lease on 1st April, it says on the inception, the lease was correctly classified as a finance lease. Now, it says, however, the facts. Now, this has gone wrong, because of the amendments in terms of Ind AS 116, because this was a little old question, so we'll rectify that part. However, the facts and circumstances on 1st April are considered, it would have been classified as a finance lease. So I think I'm cutting this sentence because now, as per Ind AS 116, it is undoubtedly going to be a finance lease itself. So we will consider that this is supposed to be a finance lease. The following is the statement of contingent liabilities on January 17. Now, when it says contingent liabilities, we know contingent liabilities, if they are measurable at a fair value, we need to incorporate the fair values in the step number 3B. So there is a lawsuit filed by a customer for a claim of 2 crores, but the fair value is 0.5 crores. It is not probable that outflow of resources will be required to settle the claim. Any amount which would be paid in respect of lawsuit is tax deductible. So he's also given you that any amount which you will pay is going to be tax deductible only when you pay this amount. So can I say when you pay this amount, it becomes tax deductible. So as of today, is this going to lead to a deferred tax implication?
Yes, sir.
Yes, because you're going to create a contingent liability as per accounting, but it's going to be deductible only when it is paid at a later date, so resulting in a deferred tax implication. Then he says income tax of 7 crores raised by the tax authorities challenged in the court. It is not probable that outflow of resources will be required. Does this make a difference that the probability of outflow is not there?
No, sir. If fair value is measurable reliably, then we can consider.
Wonderful indeed. Because when you are applying the concept of business combination 103, i.e., you can say Index 37 is going to take a backseat. In terms of Index 37, we do not consider this particular clause because Index 37 requires you to consider 3 conditions, including the probability of cash outflow, but Index 103 does not require the probability of cash outflow. So this becomes an irrelevant information for us. Then he says, in relation to the above mentioned contingent liability, S is given an indemnification undertaking to the extent of 1 crore. So this is also going to lead to a creation of an indemnification asset as well. But I think just thinking aloud, can I say the indemnification assets cannot be considered more than the amount of contingent liability captured in the books? You can recognize an indemnification asset, but that will be restricted maximum to the extent of fair value of the liabilities. Then he says any amount which is received for this indemnification shall not be taxable. If it is not going to be taxable, would this lead to a deferred tax consequence in that case?
No, sir.
That's right. Then he says the tax base of the assets and liability is equal to the carrying amount in the balance sheet. So no deferred tax implications on the remaining assets and liability. Then he says carrying value of the non-current assets held for sale is 4 crore represents the fair value less the cost to sell. Can I say this is again a part of the exception list? That when you consider the list of net assets, there are certain assets which are taken as it is, and non-current assets held for sale as per 105, Index 105, will be taken at the same value, not the fair value. So you can see some interesting inputs in the exception list. Contingent liability, indemnification assets, non-current assets held for sale, and leased assets as well. Then he says, in consideration of the additional stake purchased, it issued to the selling shareholders one equity share of H. So he's giving you how the purchase consideration is discharged. So we issue one share for every two shares. And the fair value of the equity shares of the company H on the date of acquisition is 10,000 per share. That is to calculate the purchase consideration. Then he says on January 17, H paid 50 crores cash to the selling shareholders. Additionally, it says on March 19, later after the acquisition date, he will pay 30 crore to the selling shareholders if the return on equity is more than 25%. So is this a DC or is this a CC? You will pay this amount on March 19, which is much later than the acquisition date, provided certain conditions are met. DC or CC?
DC.
No, it is condition based. So it is contingent consideration. And is it in the shareholders or the employee capacity? The condition is not service, the condition is achievement on return on equity. So CCS,
Shareholder capacity.
that's right, on the shareholders capacity. And then it says H estimated the fair value of this obligation on January 17, March 17, 22 and 23 crores. This contingent consideration is going to be considered as a financial liability, which is going to be measured at a fair value through P&L, and subsequently fair value changes will go to the P&L. He says the changes in the fair value is attributable to changes in facts and circumstances. The quoted price of the shares are given. Then he says on 31st May, H learned that certain customer relationship existing on January 18, which met the recognition criteria of an intangible assets, were not considered during the accounting of business combination. Now, there is another very interesting concept, and that is called the measurement period concept as per India's 103, in which particular case it's something similar to India's 10, that during the course of acquisition accounting, you could not record certain assets or liability, or they were recorded at a tentative value. With more information coming within 1 year from the date of acquisitions, we need to incorporate those adjustments and make changes to the goodwill in the entry. So this is the measurement period concept, because what you do on the acquisition date is called a provisional accounting. Because when you do the accounting of acquisition and you put the entries on the date of acquisition, it's a complete provisional accounting. And any estimate of assets liability and the information changes within 1 year from the acquisition date, you need to make the changes later, making changes to the goodwill computed on acquisition date. So he's telling you that certain customer relationship, they met the criteria on the date of acquisition, but they were not considered in the year ended. Now, the fair value of such relationships on 1st January is 3.5 crores, assuming there is no temporary differences associated with the relationship, and therefore there is no impact on the income tax. Then he says on 31st May 17 itself, H further learned more information coming in, that due to additional customer relationship being developed during the period, the fair value of such customer relationship increased to 4 crores at the end of the year. Then he says on December 17, the company established it obtained all the information necessary for the accounting of business combination, and no more information is obtainable. So this 31st December is the cut-off date when your measurement period concept comes to an end, because the company is going to consider the information maximum within 1 year from the date of acquisition. Otherwise, you can say, whenever the company says that, yes, this is the cutoff date, now we're not going to get any further information. So you can say 1 year is the upper limit, or the date when the company says no further information is going to come. It says H and S are not related parties, so common control cannot apply. And follow the Indians for financial reporting. Tax rate is given, so deferred tax implications will be taken. Wow. So we just read the question so far. Now it says you are required to provide detailed responses along with the reasoning and computation. What is the goodwill or bargain purchase gain in the financial statements March 17? And for this purpose, measure the NCI using PASNA. And then it says, will the amount of NCI or the goodwill or bargain purchase gain recognized in a change subsequent to 31st March? That is, he's talking about the measurement period concept, that will there be any changes? And then it says, provide journal entries. The answer is a yes. And what is the accounting treatment of a contingent consideration on March 17? Wow. So I think it's a big package of question. I think you might have done this question earlier as a part of your practice. Yes or no? There seems to be quite a pin drop
We
silence on
tried,
that.
sir.
Okay, so you managed to do this?
A bit, sir.
Okay, great. So I think let's begin the journey. So I am now going to show the answer. So question number 8, let's now work out the answer to the question number 8. So, of course, this is not a case of common control. They are not related parties. And this is a case of acquisition accounting itself. So, let's begin the journey with step by steps moving. So, let's begin with, first of all, the step number 1, which is getting the date of acquisition. So, I think the date of acquisition is the second date because this was a case of a step acquisition. But earlier, the company had a 15% stake. So, that was not the acquisition date. So I think we need to consider
Jan
1st
17.
January 17. That's right. So 1st January 17 is the date of acquisition. Then we go to the step number 2, get the accounting acquirer. So in this particular case, is the consideration primarily paid in terms of shares? I would say no. Because in this particular case, we are having a contingent consideration which is paid in cash as well. So I don't think so we can really assess that the percentage pre and post business combination. So I think we'll directly consider the accounting acquirer. So I think it's a very clear-cut case because the percentage is very clear. It's a 60% stake H acquires. So I think it's a clear-cut case that H is the accounting acquirer. So we can say H in this case has got a 60% stake. That means a control. So we can say very clearly that the legal and the accounting acquirer in this case undoubtedly is same. Because there is no case where he is losing a control of the company. So H becomes the accounting acquirer. Okay, now let's go on to the step number 3A. So first we need to calculate the implications of the deferred tax. So we'll organize all those assets and liability whose book value, or you can say the fair value, is different as compared to the tax base. So let's create a chart. So we'll make a small little chart picking up the items, considering the carrying amount or the fair value. And I think we need a little space for taxable and DDA. Let's put that. So in this particular case, we'll take the item. We'll consider the carrying amount which is equal to the fair value, then the tax base, getting the temporary differences, either it is taxable or deductible, getting a deferred tax, either it is a DTL or a DTA, as the case may be. So taxes, I think at the rate of 30%. Now we need to go back to the question, scrutinize all those assets and liability whose book value, there is a fair value, is different compared to the tax base. If there are no deferred tax implications, we'll ignore that item. So let's make a scrutiny. So let's make a scrutiny of all the items one by one. Nothing given out here on the first page. Now, we need to consider the items in this case. So I think the very first item which we can see is the property, plant, equipment. It says that there is a carrying value of 1 crore, but the fair value is supposed to be 1.2 crores. So PPE is the very first item. And this is a fair value of 1.2 crores in this case. So let me just, I think, first take the data. So I think, but this is also including a leased asset as well. I think the fair values are given separately in the column as well. So this is in the balance sheet 1.2. So let me just come out here. Yes. I think let's get the data from here because that is including lease. So this is one item, this is another item, and this is another item where it is different. All this is same. I don't know why the cash is given differently. It seems to be misprint. So you can take this as 4. So I think non-current assets will continue to be 4 only. Will not take this at 4.5. So I guess rest all the figures, these are all same. So there is no difference out here as well. So I think the only 3 items which I can see apparently is the PPE, the intangible assets, and the investments. So 90, 30, and 150. So PPE is supposed to be, I think I'll just have to pick up the figures. So PPE, what was the fair value? 90, right? And intangible assets, I think the fair value was 30. And the investments, I think the fair value was 350. So these are the fair values which we have taken. Now we can take the book values as well. So maybe you can also keep the question in front of you in the study mat. So I'll just still, for the time being, let's take you back. So this is 40, 20, and 100. The tax base will be 40, 20, and 100. Because from the taxation point of view, the deductions will be allowed to the extent of the original cost, original book values itself. So the book values becomes the tax base, the fair value becomes the carrying amount. So this fair value is more, this is more, and this is more. So taxable or deductible differences in this case. Taxable or deductible difference?
Deductible.
No. This is taxable. The carrying amount of the asset is more than the tax base. It
Asset,
becomes
asset.
taxable temporary
Asset.
difference. That's right. So now we consider a 30%. This is all going to lead to detail. 30% would mean 15, 3, and 75. So I'm just putting this. This is all taxable, and this is all DTL. Okay, now we need to scrutinize further to identify if there is any other item where the fair values and the tax base will differ. So now we are given the information regarding the lawsuit. So can I say there are 2 contingent liabilities which are given, and then it says as far as the lawsuit is concerned, it is 0.5 crores is the fair value, and it is probable that outflow of resources will be required, and then the amount will be paid will be tax deductible at a later stage. Okay, so I guess what we need to consider in this particular case is, I guess, the amount of contingent liability. So income tax is 2 crores, not probable that outflow will be required to settle the claim. So which one do we consider as a part of a deferred tax implications? Then there is an indemnification asset, but it says in indemnification asset, this is not taxable. So no deferred tax implications on the indemnification asset. So which one are you going to consider for a deferred tax implication? Is this income tax demand going to be considered for deferred tax calculations? So this income tax is a contingent liability, but are you going to consider this as a part of the calculations of deferred tax? Any inputs on that? Okay, so let me tell you, of course not. You see, when you're considering the calculations in terms of deferred tax, we are considering all the assets and liability, and this is the amount of tax itself. So this will not lead to any deferred tax implications. So we're going to consider only this 0.5, which is the contingent liability. So we take care of the contingent liability. So fair value is 0.5. And what will be the tax base? You tell me what will be the tax base. The tax base of a liability is supposed to be the carrying amount minus the future deduction. So carrying amount is 0.5. Once you pay, you get a future deduction. So what will be the tax base? I think I'll have to answer all the technical
Deductible.
Sorry?
Deductible temporary.
Zero. No, in the sense I was asking
Yes, sorry.
is the tax base.
0.
That's zero because the carrying amount is 0.5, and then you can say the future deduction is also 0.5. So 0.5 minus 0.5 becomes zero. So in this case, the fair value of the liability is more. That was right what he said. It is a deductible temporary difference. That's 0.5. So 30% would mean 0.15. That will lead to a DTA. So let's get the net deferred tax liability in this case. So that's going to be 15 plus 3 plus 75 minus 0.15, 92.85, I guess. This is the net deferred tax liability which is to be incorporated. Okay. Now coming to the inputs in terms of step number 3B, we need to get a list of all the net assets at the fair value. So step number 3B. So step number 3B, we get the list of net assets at a fair value. So again, we'll have to go back to the balance sheet to pick up all the net assets. I'll just show you the data, then I'll pick it from the question. So we're going to take this column as a base and pick up all the assets liabilities at a fair value in the balance sheet. Apart from the contingent liabilities, and we'll also consider NCA at this value, we have indemnification assets also into account. So let's go step by step. I'm just keeping the question in front of me. You can also keep the question in front of you for better results. So I think if you start with the balance sheet data, I think we've got a PPE. The item in the balance sheet of the company. So PPE is to the extent of 90 crores. Intangible assets is 30 crores. I'm just taking the information from the question. Then investments is, I think, 350 crores. These are all items I'm picking from the asset side of the balance sheet. Then next, we are given the data after intangible assets. Inventory is 20. So inventories is to the extent of 20. And then there is trade receivables, that is 20. And I guess then the next item which is given in the balance sheet is cash, that is 4. Cash is to the extent of 4. And then we've got the non-current assets held for sale. That's again going to be taken at a book value. This is not going to be taken at a fair value, but at a fair value less cost to sell. And I think that was to the extent of 4 crores. And I think least we forget there was an indemnification asset. How much was that, if you remember? 1 crore, right? I think it was 1 crore indemnification asset.
Yes, sir.
Yes, the indemnification assets was to the extent of 1 crore. So this takes care, I think, on the asset side. Rest we've got a DTL which we'll take later. So let's reduce the liabilities. So liabilities we have got, first of all, there is a borrowings, that is 20. So borrowings are to the extent of 20. The next item in the balance sheet is a trades payable, that is 28. Trades payable is 28. I think let me take the DTL least we forget. That's 92.85. That is in step number 3A. And then there is provision for warranties in the balance sheet of the company. Provision for warranty is to the extent of 3. And then I think there is a current tax liability of 4 in the balance sheet. So there is a current tax that is 4. And we need the contingent liability. We'll take the full contingent liability, including the tax payable figure. So I think that was 0.5 plus 2, I think, the income tax refund. That's 2.5. I guess that's it. We should be able to get the net assets now in this case. So this is 90 plus 30, 350, 20, 24, 4, 1. 48, 92.857, 2.5. Is this coming to 368.65? So just check if this is coming to 368.65, I guess. I think so. So this, I think, takes care of the step number 3B. Great. So my step number 3 is done. Now we need to go to the crucial step. That is step number 4, calculating the purchase consideration.
Sir, in
So,
additional points, fair
yes.
value of 1.2 crores is given. No, sir. That doesn't have any relevance, sir, here.
No, actually, this is a very old question. So in this case, what was happened is there were some inputs about lease. Uh, so now, since the lease because 116 gets amended, so there has been some changes on that. So I think maybe you can just ignore this para and take the fair values directly from the balance sheet, because when I picked up this question in a long time back, that was a little prior to 116. So I think I've just copied that version. So now if you see the study material, I think the amendments has been done. So you can ignore this para for the time being. Okay, so now let's come to the calculation of the purchase consideration. Now tell me, what are the number of agendas, number of issues in terms of step number 4? How many issues are there? The list of number of issues which you consider when you calculate a purchase consideration number. 7 issues.
7 issues.
That's right. So we're going to consider the list of 7 issues. So let me first of all consider the PC is in the form of shares. That is, generally it is in the form of shares. And I think there is also some cash. Then I think we can consider the list of 7 issues just to keep a track. So the 7 issues is number 1, DC. Number 2, CCS. Number 3, CCE. Number 4, TC. Number 5, PHI. Number 6, SBP. And number 7, pre-existing relationship. I'm just putting the list to be on a safe side so that we are able to keep a track of any movements in this case. Now I think we need to get back to the question to see what is the shares issued on the second date. So we are given, first of all, in the last para, it says in consideration of the additional stake, it is issued 1 equity share of H for every 2 shares in S. And the fair value of the shares is supposed to be 10,000 per share. So we need to see the ratio of exchange is 1:2. Let's first see the balance sheet of the company. So I guess the share capital is appearing to the extent of 12 crore. So can I say we acquired how many shares? We acquired 45% stake. So let's work this out. So we have acquired a 45% stake in the company. So we can calculate that in this particular case, the total number of shares in the balance sheet was, I think, 12 crores. The shares is 10 each. It was 12 crores, right? Total. So balance sheet is 12 crores, shares is 100 each. If the share is 100 each, then we divide this by 100. This is number of shares. We acquired 45% shares, issued 1 share for every 2 share, and the share is 10,000 each. So let's see what is the value in this case. So 12 crore shares, 12 crores per 100. So this is going to be into 45%. We'll issue one for every two into 10,000. So this is coming to how much in terms of lakhs? Because I think all the figures we have taken in lakhs, right? Or are they in crores only? They're in crores, I think. The figures are in lakhs or crores?
Crores.
They're all in crores. So we can take this total. This is going to be, I think, how much is it coming in terms of crores? 270 crores, is it?
270.
Okay, that's right. So this is coming to a total of 270 crores is the value of shares issued. Then I think we are also given the quantum of cash which is paid. Let's go back to the cash.
50 crores.
Yes, on January, another 50 crores is paid. Then contingent consideration is payable 30 crores at a later date. So I think contingent consideration, we need a fair value. So on 1st January, the contingent consideration is
390.
22 crores. That's right. So we'll take this. Cash paid is 50 crores. Contingent consideration is 22 crores. There is no DC. There is no DC to employee. There is no TC, share-based payment or pre-existing. Just we need the PHI. Now, in terms of the PHI, we need to consider the fair value. So let's get back. We acquired, I think, initially 15% stake in the company. And we know what is the value of the shares. So the quoted price of S shares, that we don't read, I think, at the moment. So we just need the fair value of the shares which was acquired earlier.
395, sir.
That is supposed to be
First
first
Jan 2007.
395. That's right. So, but we need the fair value of the shares now. So this is quoted price on various dates. But we need the fair value as on the date of acquisition, that is 1st January, correct? So we consider fair value of the PHI. So I think the total shares acquired was to the extent of 12 crore shares were there, and shares 100 each. We acquired 15% shares, and the fair value is 395. So this is going to be 12 crores divided by 100 into 15% into 395. In terms of crores, 7.11 is it?
Yes, sir.
Correct. So I think this gives us the calculations of the purchase consideration. There's nothing else. So we add up 270 plus 50 plus 22 plus 7, 349.11 crores. Well, so I think this takes care of the step number 4 as well. So the main crucial step in terms of 3B, organizing the net assets and organizing the purchase consideration, done. Now we go to the step number 5, but there's still more, a lot to go in this question. So we've got step number 5, and in terms of step 5, we need NCI. NCI, I think, is very clearly instructed in the question that it's taken at Pasna. So we have very clearly stated in the question that this is taken at Pasna. So can I say we can take the net assets in step number 3B and just take the percentage? We had 15% shares. We acquired another 45% shares. So we had a 60% stake. So NCI gets a 40% stake. So tell me, what was the net assets in step 3B?
368.65.
368.65. NCI has got a 40% stake. So I think we can conveniently get the NCI in this case.
147.46.
147.46 crores. Okay. So this is on the step number 5, that is NCI. Now we go to step number 6, which is goodwill. So this is going to be just a plus minus. So we take care of the purchase consideration, add the NCI, compare this with the net assets, and we get the amount of goodwill as well. So let's consider the purchase consideration, which we just did, 349.11, and NCI is 147.46, and the net assets is 368.65. So that will give us the amount of goodwill or bargain purchase gain as the case.
127.92.
Okay, that's great. So 127.92 is the goodwill. Okay, now just on the safe side, we'll organize the entry in terms of step number 7 as well, acquisition accounting, though I think it's going to perfectly tally. So let's look at the step number 7 as well. This is looking at the acquisition accounting entry. Just organizing the data from the previous steps. So we take care of the net assets. Then there is a purchase consideration. There is an NCI. And we get the goodwill on the debit side. We'll just pick up these figures and put them across. So goodwill is 127.92. Net assets is 368.65. Purchase consideration is 349.11. And NCI is 147.46. The entry should undoubtedly tally, but you will just still cross verify once. Yes, it is tapped. But this does not complete the question as of now. We are just done with the acquisition accounting on the date of acquisition, 1st January. Let's come back now on the other requirements for the question. So let's now come back on the data. So it's not that bad a question actually, but we just need to be very, very proactive in terms of doing the calculations, I would say. So it says, what is the goodwill or bargain purchase gain done for the year ended March 17? That is done. For this purpose, measure NCI to fair value. So point 1 is done. Then he says, will the amount of NCI or the goodwill or the bargain purchase gain, which you took in point number A, it says subsequent to 31st March 17, would that change or not? Now, this is the main area which is talking about the measurement period concept. So just to connect the dots again, whatever accounting you do on the date of acquisition is called a provisional accounting. So in this particular case, the company tentatively took the assets and liabilities at a fair value based on the information on the date of acquisition. When new information comes into light, maximum within a period of 1 year from the date of acquisition, that is to be incorporated in the acquisition accounting. But what you need to do is that if this information, you can say the conditions were present on the acquisition date, then the changes will be taken in the goodwill. But if you say that this information which you got is not relating to conditions on the acquisition date, then in that particular case, we take a hit in the P&L. So basically, you need to apply the similar concepts in terms of Ind AS 10, that if the information is relating to conditions on the acquisition date, then you change the goodwill and of course the NCI. And if you say that it is not related to the conditions, then it is impacting the profit and loss directly. So let's, I think, read the inputs once again. Let's look at the measurement period data. So I am given the information in this case that on 31st May 17, that is after the acquisition date, the company learned that certain customer relationship on the acquisition date met the criteria for intangible assets, but they were not considered as a part of the acquisition accounting. Then he says the fair value of these relationship is 3.5 crores, assuming that there were no temporary differences which are there. So this 3.5 crores is relating to the conditions on the acquisition date. So these customer relationship intangible assets were present on that date, but since we did not take them because the fair value might not have been reliably measurable on that date, so now this 3.5 crores will affect my goodwill retrospectively. And then it says there is no impact of income taxes on account of this item. Okay. And then it also tells you that further we learned that there are some changes which have taken place. It says uh, the fair value of such customer relationship is increased to 4 crores on 31st March 17. But we are going to consider the values which are there on the date of acquisition. So we'll consider 3.5 crores, which is the value as on the date of acquisition. So let's go to the point number 2. Now the question arises that if in this particular case, I need to apply the measurement period concept. If I need to apply the measurement period concept, what is the entry at which you will apply this? 3.5 crores is the value. So would you like to tell me what is the entry which will be done incorporating this intangible assets in the books?
We need to debit goodwill.
Okay, no, not goodwill. This intangible asset will now get created. Had this intangible assets been created, can I say NCI would have been larger, correct? Because if this intangible asset was a part of the net asset list, your NCI would have been greater. So there is a need to change the NCI. Secondly, if this was incorporated, the goodwill would have been more or goodwill would have been less.
It will be less.
Yes. So what we need to do in this particular case, the intangible assets will get incorporated at 3.5 crores. So you need to first of all increase the NCI because NCI was taken at Pasna. So he gets a 40% stake in this. Had you incorporated this earlier, the NCI would have been higher. So 40% of this goes to the NCI. Whatever is a balancing figure that can be reduced as goodwill. That's the reason he's telling me that is there any change in terms of NCI and in terms of goodwill. So this is 2.1. So this is based on the fair value, you can say on the date of acquisition. So whatever is the fair value on the date of acquisition, that will be taken as a part of the measurement period concept. Okay, this is another requirements, but there is more to go. So then there is a third requirement as well. It says what is the accounting treatment for the contingent consideration. Can I say the contingent consideration will be considered at a fair value and any changes in the fair value will be taken in the P&L because it's a financial liability by virtue of Ind AS 109. So let's see where is the contingent consideration fair value. Here itself, we are given the fair value. So the fair value of the contingent consideration is from 22 crores is turned to 23 crores. So we'll make a mention on the contingent consideration. So this comes the next agenda, that is contingent consideration. So we'll first make a mention to the examiner that this contingent consideration is supposed to be a financial liability measured at FPTPL, measured at a fair value through PNL, and this is by virtue of as per Ind AS 109. So the book value of this was 22 crores and then on the balance sheet date it became 23 crores. So PL debit or PL gets a credit. PL will get a debit. It's a loss increase in the contingent consideration, and that is 1 crore. Okay, so I think this answers now all the requirements of the question. So this had, acquisition accounting, measurement period concept, and a subsequent accounting in terms of the contingent consideration, a good package indeed. I think it was a good idea doing this particular question. Wonderful treat to follow.
Sir,
Yes.
in measurement period concept, value as on 31st March 4 crores is also given. No, sir. We don't consider that one, sir.
No, we
Because
need to
it is
consider the
within
value. We need to consider the value on the date of acquisition. Any further changes in terms of value will be taken as a hit in the P&L. But in any case, when you do the measurement period concept, we need to consider that, if the information was available on the date of acquisition, because you got the information at a later date, So we'll see that on the date of acquisition, what would have been the fair value. So that fair value will be hitting the goodwill. If there is any further changes, that will hit the profit and loss.
So
Means for
what?
this point 5 crores we have to adjust for PNL, sir. Then on 31st
Yes,
March
yes, yes. You
2017,
can make a mention further that any further changes now will be entering the profit and loss. So the difference of 3.5 to 4 crores will enter the P&L part. Correct. But to the extent of the measurement period concept, we will consider this entry goodwill NCI. But yes, you can make a mention for the further change hitting the P&L. That's right.
okay,
So
thank
one
you.
more question means, if in case PC is not clearly defined at the
Mhm.
time of acquisition, so in that case, the same scenario will be there. Like after acquisition, there is
Yes.
consideration. Then what we can do?
Well, in any case, I've not seen any question, where there is a concept of purchase consideration undergoing a change. Typically, the concept of measurement period is more related to the fact that there is a, lack of information for the assets and liabilities being incorporated.
Okay,
So
fine.
purchase consideration, I don't think so can be a challenge because when you're giving a PC, you're telling the person that okay, though I believe logically there could be a challenge in terms of the CC fair value determination based on the facts on that particular date. But I've not seen any question on that, and I don't think so there is any direct guidance in the standard which tells you about the purchase consideration if there is any measurement period concept. So logically, I feel it should get restricted only to the assets and liability and not to the concept of purchase consideration.
Okay, so thank you.
You're welcome. Right, friends. So I think 103 gets over on this. So I think we are now on the next phase of our inputs, which is Index 110. So, but I think first we'll take a break. Then what I'm going to do, I'm going to first make a mind map to you, where I think I want to just make some mind maps in terms of the process flow. And I'm thinking, that once I create a mind map in terms of consolidation, especially the balance sheet and the P&L question, do you want me to incorporate just the subsidiary as of now, or you want me to incorporate the subsidiary and the associate put together? The generally, I'm not seeing, questions which comes on a balance sheet with an associate and a subsidiary put together. So if you want, I can incorporate associate subsidiary put together, or maybe we can do the Index 28 discussion separately and just consider subsidiary at the moment. What do you say?
Sir, in days 28 separately, sir.
Yes, sir. Sure.
Wonderful. We'll not mix too many things at the same go. No problem. So I think we'll first take a quick break, 10, 12 minutes, and then I join you back to make the mind map and then do the questions. Enjoy your break.
Yes, sir. Thank you.
Thank you. I hope you had a relaxation of mind. So now we're going to start with a new standard or a consolidation, that is 110. Now, as we've already seen, that 110 has got a lot of aspects. One is on the control assessment, but I think I'm not getting into the control assessment part, because I think mainly when you get a question in the exams on the concept of 110, you always get a larger practical question on that. So I think my focus is going to be on the practical illustration on the consolidated balance sheet as well as on the consolidated income statement. So what I'm going to do, first of all, considering that we have done a couple of adjustments in terms of consolidation, I'm going to first of all create a mind map where we can see, considering all the adjustments, which particular adjustment is taken care in which step. So I think if you recall, there were a total of 5 adjustments which we went through on the consolidated balance sheet part. One was in terms of, you can say, the fair value adjustments. One is the intercompany owings. One is the concept of unrealized profit, that is a stock reserve. One is the concept of goodwill impairment, and the other one was omissions of any kind. So what we're going to do, we're not going to discuss the adjustments at this stage, but we just try to recall and incorporate in the mind map that, once you are preparing a 7-step model, which we decided what is to be taken care under each and every step. So what kind of nitty-gritties, focus points we need to take care. So then we'll start solving a question. So let's begin the journey. So let's first make a mind map. I think this is my mind map number 2. So for the day, this is my second mind map. So we're making mind map number 2. So this is steps for consolidated balance sheet. The focus right now is on the steps which are required for making a consolidated balance sheet as per Ind AS 110. So I think the first focus what comes to the mind is, when you're preparing a consolidated balance sheet, is you should always focus in terms of the extract balance sheet. Before even you begin the 7-step model, I would say you should filter into the question that what kind of omissions are given to us and we need to make them. Generally, the omissions would be in terms of purchase consideration. So in my mind map, I'm restricting those inputs in terms of only the generic kind of omissions which are there. So I would say, before 7-step model, before you apply the 7-step model, so your first focus point in terms of things will be, you need to see omissions. You need to see the omissions by the holding company. So I'm not saying that there cannot be omissions by the subsidiary. There can be. Whether the omissions are by the parent or by the subsidiary, extract balance sheet is definitely required. So see the omissions by the holding company, and then we need to prepare an extract balance sheet. Now let's visualize, because one kind of omissions has already come in exams. So my focus is in terms of 2 omissions. So my focus is in terms of 2 kinds of omissions. Generally, you'll see these 2 omissions in the financials of the company. One is with reference to deferred consideration, and one is with reference to contingent consideration, which is in the shareholders' capacity. So invariably, you'll see the omissions. Generally, it will relate to PC. Generally relates to purchase consideration. Now, we need to be very careful that if there is any omission with regard to DC or with regard to contingent consideration, there are 2 set of entries. One is on the acquisition date and one is on the subsequent accounting. So I'll divide this entries to be done for extract balance sheet. One is, you can say, on the date of acquisition, and one is, you can say, subsequently. So can I see, if you're looking at the omissions of a DC on the acquisition date, the entry in this case would be investment gets a debit and deferred consideration gets a credit. And can I say this will be at the present value of the future amount to be paid? And would you like to remind me that what is the subsequent accounting which is to be done from date of acquisition till balance sheet date?
Unwinding of interest.
Absolutely correct. So we need to basically go in for unwinding of discount. So UOD is going to be the focus point. And for this, you need to put the entries. Finance charge is going to get a debit and DC is going to get a credit. So we'll put the entry finance charge gets a debit. Rather, I would say you'll take the entry retained earnings will get a debit. Since you're making an extract balance sheet, in this particular case, the balance sheet is already prepared. So we will rather take a hit on the retained earnings, though it's a finance charge, and the DC gets a credit. So with these entries, you will prepare an extract balance sheet as far as DC goes. Similarly, if it is a CC in the shareholders capacity, the entry is investment gets a debit and the contingent consideration gets a credit, and this is also at a fair value. But in this case, the fair value is the present value. But in this case, it is not a present value. It is directly a fair value, which will be stated in the question. Any considerations on subsequent accounting?
If it is equity, no change. If it is financial liability, P&L account.
Wonderful indeed. So I think what you need to do is you need to make a scrutiny and decide that is it paid in cash or is it paid in variable shares. So if it is paid in cash or variable shares, then it becomes a financial liability. And if it is paid in fixed shares, then it is supposed to be equity instrument. So the form of payment is to be scrutinized in this case. And once you scrutinize that it is supposed to be a financial liability, then in this particular case, it is measured at FVTPL. It is measured at FVTPL, where the changes in fair value, is taken to P&L, or I would say effectively they will enter into the retained earnings again. But if it is supposed to be equity instrument, can I say there will be no remeasurements? In this case, there will be no remeasurements in this case. Then I think it remains as it is. So I think this is one focus point which should be very clear when you proceed with the 7th step for consolidating a balance sheet. Apparently, these are the 2 omissions. There can be more omissions, but I think we're looking at the most generic kind of omissions which might be present. Next. Then we start our inputs in terms of the 7-step model. So we've got a 7-step model for business combination, and we've got a 7-step model in terms of making a consolidated balance sheet as well. Now, in this case, the step 1 is identifying acquisition date as well as the percentage. And I don't see that there would be any kind of technicality involved in terms of identifying this data. So in terms of the step number 1, the focus is getting the date of acquisition and getting the percentage of holding. So the step number 1 would be in terms of getting the date of acquisition and the percentage. The date of acquisition will help you to decide what is pre and post, and the percentage of holding will basically decide that what is the percentage of the NCI. Then comes the step number 2. And step number 2, would you like to remind me what is the focus point?
Net assets based on equity, share capital, and other equity.
Okay, but I would say let's look at the type of question first of all. So then decide whether step 2 is got, AB or it is got just step 2, because there are 2 kinds of questions: consolidation on the acquisition date or consolidation at a later date. So what you said is correct, but I'll just go very safe. So we can say the type of question is consolidated balance sheet on date of acquisition. Though it's rare to get that question, and consolidate balance sheet later. So generally you will get this kind of a question. It's rare to get a question which is on the acquisition date. But if you get a question consolidation on the date of acquisition, can I say in this particular case, we will only directly calculate. We will directly calculate net assets. And how will you calculate the net assets on date of acquisition at a fair value? Are you going to take share capital plus other equity, or are you going to take assets minus liability?
Assets minus liabilities.
Absolutely correct. The list would be given. So in this particular case, we will directly consider the assets minus liabilities in this case. In this case,
Sir,
we'll have to do the step. Yeah.
sir, consolidated balance sheet on date of acquisition means indirectly we are looking into Ind AS 103, right, sir?
Yes, in a way, yes. But there are questions in the study mat, where we are given the consolidation on the acquisition date. So it's not 103, they've applied directly 110 as well. Though in terms of 110, you'll not get that kind of question. 99% disclaimers on.
Okay, sir.
Because if it comes, then it'll kill me. So step number 2A and step number 2B. So step number 2A, we are going to calculate the analysis of equity. We'll do the analysis of other equity, and then you'll calculate the net assets. Now, in this case, when you calculate the net assets, what are you going to do? Assets minus liability? No. So we'll take equity share capital
Other equity.
plus other equity, which is pre-acquisition in nature. Correct. Okay, now I think let's have a little more look in terms of this analysis of equity, that what are the key focus points when you do analysis of other equity. So I'm focusing now on terms of the step number 2A. So I think you want me to introduce the deferred tax part also and just put it out here. My mind sometimes tells me that there's something new which is coming in, at least Indus 12 could get merged. So you want me to put the Indus 12 inclusive in this analysis? You can say no.
Yes, sir.
Okay. So then I'll put that across. So we'll take analysis of other equity, because I think that is one input which I feel, could be a new additions coming in. Because slowly we see that questions in exams are adding on some elements, frequently. So this could be one area. Now, when you consider the analysis of equity, there are going to be a total of 3 focus points. So at the first instance, you will define the pre and post acquisition. So we will define what is pre-acquisition and what is post-acquisition. You'll define this in terms of dates, of course, that would be defined. Now we've got a total of 3 focus points when you do the analysis. You need to tune your mind that when you do the analysis, there are going to be a total of 3 focus points. Focus point number 1. So in terms of the first focus point, you need to consider the own other equity of the subsidiary company. So you need to split the own other equity of the subsidiary company, which is of course given in the balance sheet of the subsidiary company. So when you pick up the subsidiary company's balance sheet, you're going to see that all the other equity, whether it is retained earnings or share premium or any other components of equity, all will be analyzed in terms of pre and post. Next. The next focus point is in terms of fair value adjustments. Now, let me, I think, put some inputs you can vouch me. Can I say in terms of fair value adjustments, if there is a fair value gain, it's going to get added out here. And if it is a fair value loss, it is going to be subtracted from here. Correct? So fair value increase and decrease will be taken in the pre-acquisition column out here. Now, can I say if there, yes.
Can you please explain first point once again, this one?
Okay. When you do the analysis of other equity, the first thing you do is you always look at the subsidiary's balance sheet. All the other equity in the subsidiary balance sheet is segregated in terms of pre and post. That's, like the base, right? Because you always pick up the other equity in the subsidiary balance sheet, and that is split between pre and post acquisition. That is the base figure, I guess. Right? You got the first point, right?
Yes, thank you.
Okay. Then we consider the fair value gains and losses out here, and if there is a deferred tax implication. So can I say if there is going to be a deferred tax implication, DTL will be plus or minus? DTL will be a plus or minus if there is a deferred tax liability, because in terms of asset, the book value more than the tax base, plus or minus? Minus. And DTA will be a plus. So the amount of fair value gain or loss itself will result in a deferred tax. So what are you going to do in the pre-acquisition column? The fair value gain gets a plus and the DTL gets a minus. The fair value gain gets a plus, the DTA supposed to be get a plus. So if you get a DTL because of the fair value change, that's minus, and if you get a DTA, that's going to be plus. Next. Now watch this carefully. When you consider the fair value gains and loss, can I say this fair value gain or loss will also lead to, can I say additional depreciation? Or can I say reversal of excess depreciation? Correct?
Yes, sir.
So additional depreciation would be a minus and the excess depreciation is going to be a plus. So this is connecting the fair value gain loss and in the post acquisition, the additional depreciation. Next. So what will you do with this deferred tax part as well? Can I say if a portion of the asset is sold, the reversal of a DT deferred tax will take place for the sold portion. And if nothing is sold, to the extent of depreciation, the reversal of deferred tax will happen. So we can say here you need to consider the reversal. Here we need to consider the reversal of a deferred tax. And the reversal will happen on account of two major reasons. So reversal of deferred tax will happen if there is a portion sold. If there is a portion sold, we'll take care, and we will also take care of the reversal due to additional depreciations as well. Additional depreciations or excess depreciations, as the case may be. So I think let me just connect the dots. This might be getting a little complicated, but I think I wanted to pen this down. So let's watch this. When you're looking at the fair value adjustments along with a deferred tax, your focus needs to be very clear. That in terms of fair value adjustments, the fair value gain loss is a plus minus in the pre-acquisition column. And if this leads to a deferred tax consequence, the fair value gain itself is going to be a taxable temporary difference resulting in a DTL. The fair value loss itself is a deductible temporary difference resulting in a DTA. So the fair value gain amount will result in a DTL, the fair value loss amount will result in a DTA, and that's going to be a minus plus. That is all in the pre-acquisition. Now, in the post-acquisition, due to this fair value gain loss, you will have consequential depreciations impact. So if there is a fair value gain, it leads to additional depreciation. If there is a fair value loss, it leads to reversal of excess depreciation. And we also need to go for reversal of deferred tax. The reversal of deferred tax will be on account of two movements. A portion of the asset is sold, reverse the deferred tax. And due to this addition and excess depreciation also reverse the deferred tax. So you can say on the amount of depreciation, reversal calculations of deferred tax will take place. And to the extent of the sold portion, you'll have to calculate the reversal. I hope I stand clear. Next, number 3, the third focus point, tell me, is going to be what? Fair value adjustments are taken, and then there is a third focus point. What? Out of those 5 adjustments?
Stock reserve.
That's right. Upstream, downstream?
Upstream.
That's right. We'll take the upstream stock reserve out here. And in this particular case, whatever is the stock reserve on the upstream transaction, in this particular case, we will consider this as a subtraction from the post-acquisition column. Because we always consider that this is supposed to be a sale in a post-acquisition period. So reversal will be from the post-acquisition. It can never be pre, because if it was a pre-acquisition sale, pre-existing relationship would have been settled under 103. So this will always be a reduction from the post-acquisition column. So I think the 3 focus points are clear. When you do the analysis of equity, get it clear that I need to consider the base, other equity in the balance sheet. I need to consider the fair value adjustments with deferred tax implications and the stock reserve, which is upstream in nature. So step number 2 is done. Then let's come to the step number 3. So in terms of the step number 3, now we need to do what? Purchase consideration. And are all the 7 issues which we did in 103 are going to be actively triggered here as well? Yes. So in this particular case, you need to first, keep one thing very clear, that this purchase consideration should be taken from the extract balance sheet. This should be taken from extract balance sheet because you've already made the extract balance sheet. And since you've already made the extract balance sheet, it is appropriate to get the purchase consideration data from the extract balance sheet itself. But in any case, just for reference to give you that when you consider the PC, this is containing all the issues which you've done in 103. So I think these are 2 focus points. That is one. And second is the 7 issues covered in Ind AS 103 are applicable here. So they're going to be applicable here as well. So these are the 2 focus points in terms of the purchase consideration. Next. The next is the step number 4. And what is step number 4?
NCI.
That's right, the calculations of NCI. Now, I would say in terms of calculation of NCI, you've again got 3 focus points out here. Number 1, you need to consider that do we take NCI at PASNA or fair value? And immediately as you draw the conclusion that it's at a fair value, it triggers in the mind that goodwill is full. And if it is PASNA, the goodwill is partial. So impairment of goodwill will also get triggered here. So your second focus point is, of course, the goodwill impairment. And the third is you need to consider the post-acquisition changes as well. So let's put it as 3 focus points. So we have got a total of 3 focus points. So it's going to be easy to remember that, there are 3 focus points in step 2A. There are 3 focus points in terms of step number 4. So the first one is that we need the NCI on date of acquisition. And this will be either at a fair value or at a PASNA, which we decided as per Ind AS 103. So that instructions, of course, will be very clear in the question. So I don't think so. We need to really bother upon this part. Okay, now let's consider this. So I am given the second focus point is that in this particular case, goodwill impairment. Or I think first, before the goodwill impairment, let's take the post-acquisition change. We take the post-acquisition share in profits. So where do we get this post-acquisition share in profits? Step number 2A from the analysis. We're going to pick up the post-acquisition share in profits. And then comes the third focus point, that is goodwill impairment. So when do you reduce the goodwill impairment? When the NCI is at?
Full fair value.
Correct. So we reduce it if NCI is at fair value. Otherwise, this reduction will not occur. So these are the 3 focus points in terms of NCI, that first you consider fair value PASNA, which will indirectly link you to the goodwill impairment as well. And then you need to consider the post-acquisition profits. Next. So next is in terms of step number 5. So in terms of the step number 5, the focus is goodwill or bargain purchase gain, that is basically capital reserve. So when you will calculate the goodwill or the bargain purchase gain, in this particular case, I would say there are again 3 focus points. Now, I'm not intentionally making it 3, but I think it's important to keep those 3 focus points. I'll tell you what. So first you'll take the purchase consideration that's available from step 3. Then you add the NCI at date of acquisition, and that is from step number 4. And then you compare this with the net assets on date of acquisition, and then we get the figure of goodwill. Now let's give you the focus points very clear in the mind. Now this NCI on the date of acquisition and this net assets on the date of acquisition, especially if there is dividend in the question. If there is dividend in the question, I think that's an important focus point. Now you would remember that when there was a dividend in the question, I also instructed that you should calculate 2 NCIs and you should calculate 2 net assets as well. So I think let me just go back on my step number 2A, and I think step number 2B rather. So let me just connect it to the step number 2B. So can I say in terms of the step number 2B, if dividends are given, I think you would recall in the regular sessions we covered this part, that when the net assets is to be computed and dividends are given in the question, I told you must calculate 2 net assets. One is after dividend and one is before dividend. So we will calculate 2 net assets. One is net assets after dividend, and we will consider the net assets that is before dividend. So this is going to be one focus point, that you need to calculate the net assets before and after the dividends if dividend information is given in the question. Now coming back to the agenda, now tell me one thing. When you consider NCI on the date of acquisition, is this after? Are you going to take this NCI from the previous step, or are you going to consider the NCI based on net assets before or after dividend? I think nobody reacts on my technical and tricky questions, I guess.
Before dividend?
Yes, that's right. Because when you need to calculate goodwill, it is on the date of acquisition. So in this case, don't take the information from the step number 4. In that case, we will compute NCI taking net assets before dividends as a base. So we'll take the NCI calculations without taking dividends. And I think let me just also connect the dots out here. So when you're going to consider the NCI on the date of acquisition, that is PASNA, this is going to consider what? Net assets after or before dividends? This is going to be after. Yes, so when you take the NCI on date of acquisition, so you'll take the net assets after dividend for this particular point. Okay, so this is one inputs done. And when you take the net assets as well, in this particular case, the net assets will again be what? After or before dividends?
Before dividends.
Yes, that's right. So we will take this before dividends. So in this particular case, you will get this information from step number 2B, which we have already organized in this case. Okay. So I think the focus points, if we put across, the focus points which we need to be very careful on. So this is one focus point, this is 2 focus point. And then the third focus point is impairment. The third focus point is impairment. So that is my third focus point. So can I say, as far as impairment is concerned, will you reduce the impairment irrespective the NCI is fair value or PASNA? Will you reduce the entire impairment figure?
Yes, sir.
Yes, minus the entire impairment loss irrespective NCI is at fair value or PASNA, that would not make a difference. So I think the only important caution is don't take holding company share. The caution is don't take the holding company share. You need to reduce the entire impairment loss in this case. So I think this takes care of the step number 5, the 3 focus points. I'm just trying to push in, every kind of adjustments we've done, because when you do the step, your focus needs to be clear that this is what you need to do under each and every step. Okay, then comes the most crucial step, number 6. And what is the step number 6?
Other equity in
That's right.
consolidated
From
balance.
a consolidated balance sheet, we need to get the other equity. So we need to organize the other equity for the consolidated balance sheet. Now, in terms of other equity in the consolidated balance sheet, I would say then there are again a total of 3, but rather technically 4 focus points. Can I say one is you will take the, let's not take that as a focus point 1, you'll take the base. The holding company's own equity will be taken as a base from the extract balance sheet. The focus point 1 is the post acquisition share. The focus point 2 is the goodwill impairment. The focus point 3 is the stock reserve. And the fourth focus point is in terms of the dividend elimination. If dividends are given, the parent company must have credited the dividends to their own RE. But that's not an income from the group point of view, so that needs to be eliminated. So I guess we've got a total of 4 focus points. So instead of 3, we've got basically a total of 4 focus points in this case. Let's see one by one. So we will take the base. We will take the base that is holding companies own other equity. We'll take the holding company's own other equity. This you can take from the extract balance sheet. So you need to be careful, whenever you make an extract balance sheet, you need to pick up informations at various places from the extract balance sheet. Now, the focus point number 1, 2, 3, 4. So we will consider the holding share in subsidiary post-acquisition profits. And you'll get this from step number 2A. The post-acquisition, you'll get it from step number 2A. The second focus point is in terms of stock reserve, upstream or downstream?
Downstream.
That's right. We'll take downstream. That would be reduced from this place. Then the third focus point is goodwill impairment. So can I say in terms of goodwill impairment, we need to be careful again. If the NCI is at fair value, I'll reduce entire impairment or holding share.
Share of
Holding share.
Right, holding company share. And if the NCI is at Pasna, then
entire goodwill.
Entire
we'll
goodwill.
reduce the entire impairment. Then we'll reduce the entire impairment loss. And then the fourth focus point, which you will see only when dividends are given. So we can say whatever dividends holding received from subsidiary, that will be eliminated from this other equity because it's not an income from the group point of view. So I think that takes care of the step number 6, the focus points. I've tried to incorporate all the adjustments at various places to keep them as focus points. I hope this mind map helps. Then finally, we go to the step number 7. And in terms of step number 7, we need to make the consolidated balance sheet. And here I'm just going to quickly put those 5 rules which you need to consider in terms of consolidation. So we can split this in terms of 5 focus points. So this will be in terms of 5 focus points, or call them as 5 rules, whatever. I give this earlier as rule, you call it as a focus points or whatever, one and the same thing. Okay, now let's, I think, go further with this. So we are now going to consider the inputs in terms of the 5 focus points. So tell me, what are the 5 focus points? I think you'll remember the rules easily in this case.
Aggregating all assets and liabilities to the extent of 100%.
That's right, indeed. So we can say in this case, we aggregate assets and liabilities 100%, irrespective of whatever stake there might be. Great. Next one.
NCA,
NCI and NCI and goodwill separate line items. They are separate line items. Next, investment holding in subsidiary, not to appear in the consolidated balance sheet. Next, equity share capital of subsidiary company does not appear in the console. So this appears, this does not appear, and so we decided investment doesn't appear, equity share capital doesn't appear, and then other equity of the subsidiary doesn't appear. Can I say only the pre-acquisition does not appear? Post does, correct? So these are the focus points in terms of things. Okay, so far so good. I think that corrects the inputs out here. Okay, so I think this is the mind map in terms of all the 7-step models in this case. You want me to make a mind map quick on the control assessment, or should I skip that? Your choice.
you can skip it, sir. We will read it.
Wonderful indeed. So I think now let's then do a small little question on this area. I have put some longer questions only. Okay, before that, I think let me make another mind map as well, because I might run short of doing that questions in the next 25 minutes. So let me take a liberty of making another quick mind map out here. So we can do questions and questions in the next class with you. Because I've taken around 3 to 4 questions, full-fledged questions, 2 questions on the chain holding and 2 questions normal. I've taken only past examination questions to do with you. So let's create a third mind map to begin with. So let's create a mind map number 3. So that's, I think, the third mind map for the day, I guess. I think we made, yes, second. So third mind map. Okay, so there's another area which is there in terms of Index 110, which is leading to concept of, you can say, loss of control, or you can say the control continues. So let's make a wonderful chart and combine the inputs. So we are looking at changes in ownership interest. So I'm looking at the concept of changes in ownership interest. The changes in ownership interest. So let's consider this changes in ownership interest. If you remember, there are a lot of permutations, combinations in this case. So I think I'm not making the chart which I made earlier, but I think we can just concentrate on different permutations, combinations in this case. So my mind is now working in terms of certain areas of inputs. So my mind is working on 3 blocks. So the first one is, the first block what my mind is working on is that it is a case of a step acquisition. If it is a case of a step acquisition, so we can say it is either a case of conversion from a passive investment to a case of control. And it is either a case of cigarette influence to a case of control. So can I say these two cases were covered in terms of Ind AS 103 itself. So I'm not discussing them at length, but I just want to remind you that if there is a step acquisition conversion from passive to control, a conversion in terms of signet inference to control. Now, I have a good question on this area, but I think we'll just quickly make some inputs. Can you tell me, in this case, where will the fair value updation go? When you update the fair value, where will this fair value update go? 109 to 110. We did this in 103. So where will the fair value update go? Changes in the fair value? Okay, I think I'll have to answer that. P&L or OCI as the case may be, correct? Because as per Ind AS 109, you would have taken the investment at FPTPL or FPT-OCI. So accordingly, the fair value gains will either enter the P&L or the other comprehensive income, correct? And what happens to the balance, accumulated balance in OCI? It is supposed to be transferred where? If it is FPT-OCI, where is it transferred?
Retained earnings.
That's right, it goes to RE. Okay, now if it is a case of signet influence to control, so where do you take the fair value update? Can I say P&L? Because you're using equity method, it goes to the P&L. Anything else which is required in this case?
Scrutinizing OCI.
Very good. So we need to do a scrutiny of the OCI. So can I say whatever is the balance in the OCI, that will be scrutinized. So once you scrutinize this balance, if it is a case of R and if it is a case of NR, can I say R will go to the P&L and NR will go to the retained earnings? Okay. So this is practically, what we have covered in 103, but I'm just putting it out here. So this is already covered in 103. But just to connect the dots and put it all across one place. So this is step acquisition. Now the next one is again a case of, you can say, either a step acquisition or a case of disposal. Let's not put it as plus. So it is either a step acquisition or a case of disposal. In this case, both the cases, control continues. In both the cases, the control continues. So what is the focus entry in this case? When the control is there, you still continue, whether it's an acquisition or a disposal. So what is the focus point? In step acquisition, can I say the entry is, in this case, NCI gets a debit, bank gets a credit, and where is the balancing figure taken in this entry? Directly equity.
Yes, sir.
And if it is a case of a disposal, can I say the entry is bank gets a debit, NCI gets a credit, right? And here again, the balancing figure is taken to equity, because this is a dealing between the shareholders. So in this case, we just take the NCI as a debit or the NCI as a credit. Now, my question quick back again to you. When you take this NCI, so is this NCI including goodwill, or it depends? The NCI debit or credits will be share in the net assets plus goodwill, or net assets without goodwill, or depends?
It depends, sir, based on NCA calculation.
If the NCI is at a fair value, then we'll take net assets plus goodwill. And the NCI is at PASNA, then it is supposed to be just net assets without the goodwill, correct? So that's the only caution in this case, where it is step acquisition or a case of disposal. Next agenda. Now we're looking at a case where there is a loss of control. Now we're looking at a situation where there is a loss of control. Now, if there is a loss of control, can I say in this particular case, do I put the reversal entry of acquisition accounting? Reverse entry of Index 103, correct?
Yes, sir.
So can I say this could contain a lot of permutations, combinations? It could be a case where it is a full disposal or it is a partial disposal. It could be a case of converting to associate, converting to passive investment, everything covered. So this will cover all the cases, whether it is a full disposal or it is a case of partial disposal, where it could be converts into associate or converts into a passive investor. Everything is covered in this combination. So let's say the entry in terms of reversal entry. So bank gets a debit and investment gets a debit, which is retained if any. And this will be taken at a fair value. So we'll take the bank gets a debit, investment gets a debit for the fair value retained if any. Then NCA gets a debit. Then there is net assets and goodwill gets a credit. And balancing figure in this entry will go where? Profit and loss.
P.
The balancing figure in this case enters the P. Right, so I think that takes care of the changes in the ownership interest in the company. Step acquisitions covered in 103, but just we connected the dots. This is when the control continues, and this is when there is loss of control as well. Now I think let's do a question on this area. So let's.
And just a minute, I should note it out.
Yeah. Done.
Yes, sir, done.
Okay. So let's do a question on this area. I've taken an interesting question. Yes, question number 10 on this area. I think this is one of the comprehensive questions on this area. This is there in the study material as well, and it's there in the education material as well. We'll probably solve it on the right hand side. Looks big, but it's not that bad indeed. So let me just open the question also. We can just keep solving this. Right, so let me just read the inputs now. It says at the beginning of the current financial year, A has got a 90% equity interest in B. And during the year, it sells a 70% interest. So what is this case? Is it a case of loss of control? Correct? This is a case of loss of control, correct?
Yes.
So which means the company was already having a control, and then it sold 70% interest for 56 crores, and consequently it loses the control in terms of B. Wow. Now this is interesting indeed. Then he says at the date of disposal, the fair value of 20% interest retained is 16 crores. The carrying amount of net assets of B in the consolidated financial statements as on the date of 70% interest is 60 crores. So I think the value of the investment retained is given. The net assets on the date of disposal is also given. But the interesting part is the ABCD. It says the aforementioned net assets includes the following: investments in debt instruments classified as FPT-OCI, that is 12 crores. Related cumulative fair value gain is 6 crores. Now, by the way, which case is this one? Is it 1, 2, or 3?
3.
But do you see that I've taken any entries with reference to scrutiny of the other comprehensive income? No, but it is
No.
possible. But it is possible that even in this case, the scrutiny of the OCI occurs, and that's what the uniqueness of this question is. So when it says that investment in debt instrument is 12 crores and the related gain is supposed to be 6 crores, now the question arises, is this a case of R or NR? It is R, correct? And then it says net defined benefit liability. This is including the effect of cumulative losses on account of remeasurement of net defined liability recognized in OCI. So is this a case of R or NR? It's Index 19. Remeasurement gain or loss.
NR.
That's right, it is NR. So R will be taken to the P&L proportionately. That is, to the extent of the parent share will take it to the P&L. This proportionately will be taken to the retained earnings in this case. Though, let me also tell you that in terms of net defined benefit, this money already goes in retained earnings. If you remember, in terms of Index 19, you would have done the remeasurement gain or loss goes in OCI, but from the OCI, it doesn't go in tab 3, but it goes in tab number 2. This is an exception in Index. I hope you remember. Though I didn't cover Index 19, but you might recall. It says investment in equity instruments not held for trading with an irrevocable option of taking the fair value changes in OCI. So is this R or NR? Equity investments, equity OCI.
R.
NR.
No, equity is never R. Debt is R, equity is NR. And then it says net assets of a foreign operation is given and the cumulative exchange gain of 8 crores is given. And this is also taken in OCI, R and R. It's a FCTR on account of Index 21. So foreign currency exchange. That's right, it is R. It is on the disposal of the foreign operation. It goes in the P&L. Then he says in the consolidated financial statements of A, 90% of the gains in ACD. He did not mention B because B in any case went to RE. Is included in the separate components of equity, that is tab 3. And 90% losses in B has been taken in retained earnings. That's I've already told you. The remaining 10% is attributable to NCI as a part of the NCI. The carrying amount of NCI on the date of disposal is given. How do you account for the loss of control in the subsidiary in the consolidated financial statements? So we need to put, two different set of entries. One is for the entry reverse, putting a reverse entry for acquisition accounting, and then the proportionate amounts in OCI to be transferred to PNL or RE as the case may be. So let's, I think, first begin with the reversal entry. So we'll first put the entry bank gets a debit, investment retained if any gets a debit, NCI gets a debit, net assets and goodwill gets a credit. So we'll just pick up the information from here. So let's see what is the amount at which investment is sold. We sold the investments at what value? 56 crores. Investment retained at a fair value is 16 crores. NCA on the date of disposal is given to me, it is 6 crores. And net assets on the date of disposal is, I guess, 60 crores. Are we given any goodwill status in the question? Or is there any data which is given with which I can calculate goodwill on acquisition date? I think no. So in the absence, I assume that there is no goodwill, or maybe it stands impaired, whatever. Now let's see the balancing figure in this case. I think it's 18 on the credit side. So that would be a gain which will be taken at the profit and loss. So this is one entry which we do once the disposal of the shares takes place, resulting in a loss of control. Now we're going to put entries for these 4 points as well. So let's begin with the first point. So what is the amount of cumulative amount in OCI? Can I say the fair value gain is 6 crores? So what will I do in this particular case? Can I say I will debit my OCI and credit the PNL because it is a case of R. So out of 6 crores, 90% becomes how much? 5.4 crores. And what about the point number B? Is there any entry to be done for point B? This amount is as it is standing in the retained earnings column. So can I say nothing to be done? I don't need to make any transfers for point B. Then it says equity investments. So this is going to be taken where it is a case of NR. So we'll put this in retained earnings.
Retained earnings.
Correct. So this is, I guess, a cumulative fair value gain of 4 crores. So 4 crores into 90%, 3.6 crore. And then finally, in point D, it says that there is a fair value gain. This is 8 crores. This is a case of R. So can I say OCI and this goes in the PNL?
PNL.
So 90% of 8 crores, that is 7.2 crores. Okay, so I think that takes care of the input. So this is 2 different set of entries which are done, which means moral of the story, that even if it is a case number 3, because in terms of the case number 3, generally what comes to the mind is that you need to put a reversal entry of the acquisition accounting. But the focus out here is that not only the reversal entry will be done, but the amount which got accumulated in the other comprehensive income, that is to be scrutinized in terms of R&R and then parked in the P&L or RE as the case may be. Right, so I think that's the only question I think I put on this changes in ownership interest. Yes. So now we are just left with areas of doing questions on Ind AS 110. So what I'm going to do tomorrow, I'll do questions on Ind AS 110, only practical illustrations with you. Then thereafter we'll come to questions on Ind AS 111, mind maps and all, and Ind AS 28 later. So tomorrow we'll focus in terms of Ind AS 110. I think that's almost what we have time for, unless you've got any questions to ask. Okay, so I think that seems to be good. Yeah.
Mind map 2, can we discuss once more?
Mind map number 2.
Yeah.
Mind map number 2 is the 7 steps.
हाँ वो उसमें third step was like a little bit confusing. I was just revising.
The third step, you mean analysis of equity?
Yeah, analysis of equity.
Okay. I just added the deferred tax points. So let me just give you the critical points. You know the fair value gain or loss. You know the initial depreciation, right?
Yeah.
The only thing which you need to remember is the fair value gain itself is a taxable temporary difference. Correct. So when it is a taxable temporary difference, it will lead to a DTL. And DTL means that you will create an expense. So this fair value gain is taxable difference resulting in a DTL. The fair value loss is a deductible difference leading to DTA. Got it?
Yes, sure.
Next. Now, when you take additional depreciation, you'll end up reversing the deferred tax. So whatever is the amount of additional depreciation itself represents the reversal of the taxable or deductible differences. So you do the reversal of deferred tax. And if a portion of the asset is sold, let's say you revalued an asset, 20% portion sold. So 20% of the deferred tax will also get reversed. Because deferred tax created gets reversed when you sell the asset or when you take additional depreciation. These are the timing factor for reversal of deferred tax. Therefore, we have taken the reversal on account of these 2 reasons. I think in my regular sessions, I've done that question also, where I've taken the practical illustrations with the deferred tax implications.
I'll see
So
that.
tomorrow can we do a question with these implications, sir?
I have a larger question that takes around 1.5 hours to solve. Last time you was told don't do any questions other than exams. Maybe we can add that later if time permits. But I think we've got 2 more sessions to go. So tomorrow I'm going to devote questions on 110. Then I need to do 111 and 28. 28, I need to do the appendix as well. Because that question I did in the regular sessions, it takes almost 1.5 hours or so to do it actually.
Sir, if not the entire question, just the
Okay, example.
adjustment. Everything.
Done, done. I'll do that. Just remind me that tomorrow I'll show you with the practical figures how this, calculations done. I'll do that.
Yes.
Thank you, sir.
Thank you, sir.
Thank you very much. Thank you. Right, friends. So see you tomorrow morning. Thank you very much. Bye bye and take care.
Thank you.
Thank
Thank
you,
you,
sir.
sir.
Thank you. हाँ जी क्लास ओवर हो गई